So thank you so much for joining us. Tell us a little bit about what you do.
I'm an investment banker. I work entirely with privately owned companies, privately held. I work on both the buy side and the sell side, primarily sell side. And about half of what I work on is family-owned businesses.
Oh, okay.
So it's got a different kind of a twist to it. It's a little bit more of an emotional.
What's the difference between striking a deal among family businesses and corporations?
There's a world of difference, right? It's an emotional decision. Most of these privately held businesses, especially family-owned businesses, were started from scratch. Could be a husband and wife. Could be just an individual started it. Could be a couple of sons in the business, and they put everything on credit cards, personal guarantees, mortgage their home. And over the years, they've had employees that they've known for 10, 15, 20 years. They've watched them have their first baby, their second baby, buy their first home, and they built the business together and went from 2 employees to 150 employees. And so selling that company brings a lot of emotion with it.
Sure.
That from a corporation's perspective is more of just a business transaction, as opposed to what does this mean to my legacy? What does this mean to the people that I've loved and who've been my employees for 20 years?
How do you deal with it as an advisor? You obviously would say, oh, this transaction makes sense from a financial perspective, but how do you handle their emotional stresses?
That's a great question. The president of our company will sometimes say that more of what we do is the role of a psychologist than an investment banker. And there certainly is a component of that, because you have to be able to get inside of kind of the heart and soul of how did this business come to be. I remember a couple of years ago a business owner saying, there came a time in my business where I had to decide between paying the mortgage on my home that month or the mortgage on the building for my business, because I couldn't afford to do both. And so I paid the mortgage on my business, and the next week my wife left me. And she came back because I had to explain to her that without the business we didn't have a home, and if we didn't pay the mortgage on the business, the doors were going to get locked. So that's the emotion that comes behind that kind of a sacrifice. And if you can't kind of get inside of the heart and soul of what they feel about their business and how personal it is to them, then you're not going to be able to relate to the transaction. It's not just a financial transaction for them. It certainly has that. It may cause them to have an inflated view of what they should be paid for the business, because there's so much blood, sweat, and tears that's poured into it. How do you get compensated for that?
Is there even a valuation method for that?
No, not for that. I mean, you can run all sorts of DCF models and everything else on the business for what is the true value of the business, but what is the goodwill of 20 years of my life and my private life invested in my family, worried from time to time about how are we going to make this Friday's payroll, much less this month's bank payment, to keep this business running.
So how do you convince somebody, say a gentleman who started this business when he was 20 and now he's 50, the business is very profitable, he could sell it for X billion dollars or however much money,
millions, right?
And then, but he doesn't want to sell it. How do you convince the person?
Well, you don't convince someone to sell it who doesn't want to sell it. Deals only get done between committed buyers and committed sellers. And if you don't have a commitment on both sides of the deal, it won't get done. That's why so many deals fall apart. So you don't convince a seller to sell. He has to understand what that value proposition is for him and his family, if it's a family-owned business, or if it's personally held or privately held, closely held, then what is the value proposition for the business, for him, for the future? And in many cases, what it means is not only securing your financial future and the financial future of your family and estate planning, but you may be securing the financial future of 3 generations that'll outlive you. And the ability for your great-great-grandchildren to go to great colleges and have a chance in life that you never would have had. It may be the opportunity to, fulfill a lot of ambitions and life dreams that you might not have ever imagined. Or to take the business to a place that you couldn't take it yourself. The reality is that there is a certain skill that comes with entrepreneurialism that can propel a business to a certain level, and then it is a level of professional management that can take a business to 250 million or $500 million in revenue or $1 billion company. Those are not always the same skill set, and it takes some discussion, just like this, with an owner to say, are you that person, or can you take it to this level with a partner? Professional manager takes it to another level, you're the chairman of the board, and that value proposition for you, for your family, and for your legacy as a family could be something that lasts for many generations. That's a compelling idea. I remember reading a brilliant white paper just about 2 years ago by Credit Suisse that covered about 30 different transactions with private business owners. And I don't think they intended this to be the message that came out of the white paper, but as I read it and began to flag things that were common about these deals, that ranged anywhere from $15 million for the transaction to $200 million. Okay, so very broad range of size. All privately held companies, about half of them were family-owned businesses. All of them had an interesting theme in common. Out of the 30 or so, all but one went on to tremendous success. They all were philanthropic with the proceeds from their transaction. Only one was not philanthropic, and his transaction turned out after the closing to be unsuccessful for him and for the business. That wasn't the theme of the white paper. It was an interesting thought. I think corporations certainly can be philanthropic, but the individual who has poured a lifetime into creating jobs for families that he can walk right out the door from his office and see someone like you or me who's worked for him for 15 years and they've had a career path and a job's been provided for them and their family. These owners take that very personally. For them then to take that next step into having new wealth that can be used for philanthropic causes is a compelling theme for why would I do this. So how do you guide an owner? Well, these are the kinds of things you're going to be able to do that you may not have been able to do before. It's not always a lifestyle change for them. The business may have been spending off enough cash that they've got a great lifestyle. It's not like they need to put millions in the bank. But now a sudden windfall can put them in a totally different category of thinking about what can I do for employees, what can I do philanthropically, and how have I provided for my family for 3 generations.
Right now, I want to ask you, because there's a consensus the U.S. economy is recovering. The question is how quickly, and I want to ask you, how is the recovery helping these private owners? Do you see a pickup in
well,
deals?
there's definitely a recovery. There's not a pickup in deals.
Okay.
This is probably, arguably, has been a more sluggish year even than 2012 was.
Oh, right.
And people thought that 2013 probably would be a massive big deal year, right? And I don't think anyone believes that that's happened, not in M&A. But there's no question there's been a recovery. It's just not been a recovery at the rate of speed that business owners like to look, particularly private business owners.
Yes.
So take a step back and think like the private business owner. 2008, 2009, you were thinking about potentially an exit. You're a younger baby boomer or approaching the middle part of the baby boom age, and you're thinking probably in the next year or 2, maybe 3, I'm going to consider a transaction. The bottom falls out. Your EBITDA falls from $30 million a year to $15 million a year. The ability now for you to get the value for your company is at least 3 years away, because it's going to take you that long to build back to where you were. So now you've got to build back for 3 years from 15 to 30, just for this example's sake. You get back to 30, you feel like you've now invested more of your life than you ever have before to get back to where you were, and now you're ready to do a transaction? By the way, most of them aren't back yet.
Correct. Yes.
They're back, but they're not all the way back. And so it's really a difficult pill to swallow. I mean, I started this company with my credit cards. I have personal guarantees. I have 250 employees. I've created a tremendous tax base for the markets where I operate. Now you want me to sell my company, and I'm not even back to where I was, and I'm not going to be able to get paid for it what I should be paid. I'm going to have to hang on for another year or 2. That's
because they're optimistic about the outlook, or it's a personal attachment?
There may be an element of both of those, but it's probably more, I'm going to get back to where it was so that I can get paid. Because why would I take less than I would have taken 3 or 4 years ago if I'd have done the transaction then? I wasn't ready then. I would be ready now, except my company's not worth what it was then, so I'm just going to hang in there because I'm going to place a bet on myself. That's the thing that separates the entrepreneur from the corporation. They've been making bets on themselves for 15 years or 20 to bet on themselves for 2 or 3 more years. They're not betting on the economy.
I see. Okay.
They're betting on themselves.
Yeah, that's a very different mentality.
They're betting on themselves. They're betting on their employees. That's the entrepreneurial spirit. We can prevail. We've done it before. We're proving that we can do it again, and we will.
Okay.
Oh, by the way, would the rest of you guys running the country please try not to screw this up for us this
so what
time?
I'm saying is, how important is regulation for you? How important are the policies for you?
Well, that's going to depend on the sector, right? If you're, 82% of the deals today get done in energy, healthcare, and technology.
Yeah, that is.
And so energy and healthcare are highly regulated industries. It depends on which subsector you happen to be in. But most entrepreneurs don't look at regulation as an impediment. They just look at it as a reality of life, and I'll get over it. It is this perpetual entrepreneurial spirit that propels these privately owned companies, right? That, well, okay, another curveball, but so what? Right. I've been hitting curveballs for 20 years, and I'll figure out how to hit this one too.
Right. I'm from California, and
highly
I have
regulated.
A lot of friends in Silicon Valley who talk about startup ideas. Like, we throw ideas at each other, like 3 a week per se.
Sure.
And the mentality is very different over there. I'm just going to go do it. And in New York, it's sort of like, okay, what kind of loopholes can I,
exploit?
Yeah, exactly. Do you feel that's the same thing when you do a corporate transaction versus a privately owned transaction? Do you feel the difference in mentality is that dramatic?
There is, yes, there is very much a different mentality. A more corporate environment's going to bring a greater level of sophistication. There probably is a very specific goal or set of goals in mind for the transaction that pertain to growth, pertain to exit, pertain to creation of value for the shareholders. And so it's, I wouldn't say it's cookie cutter, but it's a much more crisp, much more fully baked concept of what we're going to do. For the entrepreneur, there's some of those components, but there may be a level of unsophistication about deal making.
Sure. Many
times this is their first deal. It may be their only deal. It'll be the biggest deal of their lives for probably 80% or more of them. And so it's a new process. It's all new to them. And being able to step through that and have a successful financial component, if they're staying with a sponsor, a successful roadmap for the future of how do we grow this for the final exit, and then successful from that emotional perspective of how does this meet my family's needs, how does this protect the family legacy, and how does this take care of my employees. So those are kind of very different ways of looking at it, and as a result, you'll have a level of sophistication that comes with a more corporate type of a deal, more prepared, more buttoned up, very specific direction wrapped around the transaction, as opposed to maybe more entrepreneurial, not all systems in place that are needed, and the real opportunity to create value for substantial growth for the future. In terms of your example of I'll just go do it, that's that new wave of entrepreneurial spirit that's coming with this next generation. I have a son who is that next generation, and he's talking about starting a business. I think sometimes our country gets the impression that this next generation after the boomers doesn't have this same entrepreneurial verve of the past, and that I don't believe that's true at all. The ability to, I'm going to go out there and I can do it, ultimately is what's created the best companies in this country.
There was a book, I believe it came out at the end of last year. It's called Built to Sell. It teaches young entrepreneurs to build a company with the intention to sell from day one. Even if you never planned, you want to automate the business, you want to, do the best job possible. What are some of your advices to these
Build
people?
to sell?
Yeah.
Well, everything in a company starts with the customer. And every great transaction, as an intermediary, I get to see it, whether I'm on the buy or sell side, leads back to the customer. So if you don't have a very clear perspective of what's going to be good for the customer to build the business, to sustain the business, and to grow the business will lose its way. And ultimately, it'll go through a series of failures that force it to come back to its core, which is, why do we do what we're doing? Which is ultimately to do something for the customer. So build to sell has to begin with the customer. Then build to sell has to very quickly relate to another customer, which is the employee. Because employees are what build a company. One individual can have a vision for a company and may be able to guide a company, but one individual cannot build a company alone. It takes all of these people who are working in a company to understand their role to be able to build that company. And the responsibility of ownership is to be able to understand the value of that customer, the customer who works for me, that I'm here to take care of. If you then build that employee base, you've protected your employees, you've protected your customer, you're now positioned to really grow, and you'll have a story to tell that'll allow you to sell the business.
Right now, in terms of privately owned business, small business alike, do you think it's easier to sell a business that specializes in something and only that one thing, or it's a general business that has an easier time?
Well, first of all, there is no easy business to sell. There are no easy transactions.
Yeah, of course, like relatively. Yeah.
So, but I would say, I think it depends a bit on the deal size and who the buyer is. If it's a strategic sale, then strategic diversification could be critical, and being overly niche-y might not be a great fit. Could be, depending on kind of the situation, but being able to add some diversification that also integrates well into a bigger company from a strategic perspective might be better. From a sponsored transaction, a little more niche-y might be attractive, depending again on the size of the transaction, because it becomes a platform on which you can hang other lines of business or other types of companies, and easy to bring in add-ons and create a much bigger business. So, and that can be relative to size. If you're if you're doing transactions that 100 million or larger, or or 20 million to 50 million in EBITDA, or 50 to 100, things change. You're not going to do a 250 million or 500 million dollar transaction that's sponsored without the business coming with that diversification. So you start down market, you start with a platform that you can diversify, and then take it up to a larger private equity group that takes that diversification, expands upon it, and refines it. So I think it depends on the size of the deal, depends on how much money's going to, how much capital is going to be deployed, and what is the real investment thesis for whoever that buyer is at that size or stage of the game.
Do I have time for one more question? Okay, just one last question. In terms of due diligence, what do you think is the most important thing?
Patience and cadence is not one thing, but they go together. A deal has to have cadence. All transactions that get closed really manage under a certain cadence. And when that cadence is lost, time begins to work against you, and the deal begins to get fettered around the edges.
Okay.
You can get deal fatigue. Something can go boom in the night with the company, and if a transaction doesn't get done, there's been a disservice done to all sides of the deal, because they didn't get into it not to get it closed. And if it hadn't been marshaled and moved at a certain cadence, it would have been closed, most likely. That said, in order to move that cadence, it takes patience. Because it can't just force the cadence and drive the deal to a conclusion or you'll create anxiety that'll cause the cadence to fall apart as well.
Well, nowadays in your space, what is the #1 reason why deals don't close?
Poor LOIs.
Okay.
If an LOI is not well conceived and critical components of the LOI are not spelled out, then a deal is going to have trouble later. An LOI should be looked at as the Constitution and the stockholder purchase agreement as the law. And if you don't have a good Constitution, you're not going to be able to write good law. And you're going to have law that comes down in the form of a stockholder purchase agreement that's not an agreement with the LOI because it wasn't well conceived. And suddenly the seller gets surprised, the buyer doesn't understand why, and emotion creeps into a deal and it loses cadence. And probably 70% of the deals fall apart because of bad LOIs.
Okay, thank you so much.
You bet.
Yeah, that's all.